Right now, as we speak, Credo Technology Group is trading at exactly 206.92 USD, surging by an absolute tear of 35.79 points, which translates to a massive 20.91% gain just in today's intraday session. If you are watching the ticker tape on your Fidelity mobile app or tracking the candles on Interactive Brokers trading screens, what you are seeing isn't a glitch. It is a repricing event of the highest order. The market is waking up to a reality that a few smart insiders saw coming months ago, and the volume we are seeing today confirms that this isn't just retail enthusiasm, it is a structural rotation. When you look at a move like this, the immediate expectation is that it must be hype. We are conditioned by the last few years of market volatility, watching Tesla stock swing wildly or Nvidia stock defy gravity, to assume that a 20% move in a single day for a connectivity company is just another flash in the pan. The general consensus or expectation was that Credo would report decent numbers, maybe a modest beat, and the stock would grind slowly higher as it rode the coattails of the larger AI chip makers. That was the safe bet. That was what the analysts on the Schwab Intelligent Portfolios dashboards were likely predicting. But the reality? The reality is that Credo has just shattered the ceiling of what was considered possible for a connectivity player. They didn't just beat earnings, they obliterated the thesis that the AI trade is only about the GPU. The reality is that while everyone was focused on the brain of the AI data center, Credo cornered the market on the nervous system, the high-speed cables that actually make those GPUs talk to each other. This gap between the boring hardware expectation and the critical infrastructure reality is exactly why you are seeing this violent upside repricing today. Let's strip away the noise and look at the mechanics of this move. If you are using Robinhood stock trading tools or digging into the Level 2 data on a Fidelity trading platform, you will notice something specific about the order flow today. Usually, on a 20% gap up, you see a lot of profit taking. Retail traders who got in early often sell the rip. But today, the bid-ask spread is tight, and the buying pressure is relentless. This suggests that the people buying Credo Technology Group at $206 aren't just day traders looking for a quick flip. They are institutions. We are talking about Fidelity wealth management funds and major pension allocations, realizing they are underweight on the one component that bottlenecks the entire AI cluster. The volume today is multiple times the average, which is the classic footprint of fear of missing out. Not from the little guy, but from the giants who realize they missed the turn. To understand why this is happening, you have to understand the specific technological problem Credo solves. And I'm going to explain this simply, without the corporate gloss you'd find in a press release. In an AI data center, you have thousands of GPUs that need to act as one single supercomputer. The speed at which they calculate is irrelevant if they cannot send that data to the chip next door fast enough. This is the connectivity wall. For a long time, the industry thought the answer was optical cables, using light to transfer data. And for long distances, it is. But for the short distances inside the server rack, the critical few meters connecting one processor to another, optics are expensive, power-hungry, and run hot. Credo's bet, which many doubted, was that they could make standard copper cables smart enough to do the job better, faster, and cheaper. They developed what are called active electrical cables, or AECs. They put a tiny specialized chip inside the cable itself that cleans up the signal, allowing copper to transmit data at speeds that were previously thought impossible. This brings us to the news driving today's price. The earnings report released recently didn't just show growth, it showed adoption. The revenue growth is clocking in at figures that make mature tech companies look stagnant. We are looking at a 272% year-over-year increase. That is not a typo. When a company grows its top line that fast, it means they aren't just selling a product, they are fulfilling a desperate need in the market. The hyperscalers, the Microsofts and Amazons of the world, are buying these cables as fast as Credo can make them, because without them, their billion-dollar investments in Nvidia stock chips are inefficient. If you are sitting at home managing your SoFi investing account or looking for investment help on foreigns, this is the nuance that separates a good trade from a great one. You aren't buying a cable company. You are buying a royalty on every new AI server rack that gets installed. Let's talk about the broader context, because it's easy to get tunnel vision when a stock goes vertical. If you compare this to Apple stock, Apple is a play on the consumer ecosystem, steady, massive, cash-rich. Credo is in a different phase entirely. It is in the infrastructure build-out phase. Think of it like the railroad boom. NVIDIA built the trains, but Credo is laying the specialized track that allows the trains to run at full speed without derailing. If you are engaged in self-investing or using online investment tools, you need to categorize this stock correctly. It is high beta. It is volatile. Today's 20% gain could easily see a 10% pullback if the broader semiconductor sector cools off, and you need the stomach for that. The interactive broker's fees for margin trading on a stock this volatile can add up, so this is a spot for conviction, not just speculation. I want you to pause for a second and look at the intraday chart. Notice the stair-step pattern? It jumped at the open, consolidated, and then legged higher again. That pattern often indicates that buyers are stepping in at every dip. It's a sign of accumulation. If you are using SoFi Active Investing or Robinhood fractional shares to build a position, this is the kind of price action that gives you confidence that the floor is rising. The market is effectively saying, we were wrong about the valuation of this company yesterday, and we are correcting it today. This isn't just money flowing in. It is a re-rating of the company's future cash flows. Now, I want to pivot to the risks, because being a smart friend means I have to tell you what could go wrong. The expectation now is perfection. With the stock trading at these multiples, Credo has to execute flawlessly. If a major customer like Microsoft decides to switch to a different connectivity standard, or if a competitor like Marvell Technology releases a superior AEC product, this stock could contract violently. We saw this happen with other high flyers in the past. The semiconductor industry is cyclical. Right now we are in the super cycle of AI spending, but eventually that spending will normalize. If you are managing your own Fidelity IRAs or individual brokerage accounts, you have to ask yourself, am I buying the top of the hype cycle, or is this the second inning? The data suggests we are still early in the transition to 1.6 terabit speeds, which is the next frontier for Credo, but the valuation risk is real. You are paying a premium today for growth that hasn't happened yet. Speaking of holding patterns and investor psychology, I want to hear from you. Comment below how many shares of Credo Technology you currently hold, or if you are kicking yourself for watching it from the sidelines today. Are you waiting for a dip that might not come, or are you chasing the momentum? Let's look at the institutional landscape again. It is worth noting that Fidelity Investments and other major asset managers have been increasing their exposure to the semiconductor supply chain, moving beyond just the chip designers. They are looking for the picks and shovels of the AI gold rush. Credo fits that description perfectly. When you utilize investing sites to research Fidelity mutual funds or Fidelity ETFs, you will likely see Credo popping up in the holdings of aggressive growth funds more frequently. This institutional backing provides a bit of a safety net. These big players don't typically dump their entire position in a single day, which dampens the downside volatility compared to a stock that is purely owned by retail traders on the Robinhood app. There is another angle here, the geopolitical aspect. Credo has navigated the complex supply chain issues between Asia and the US relatively well, but like all hardware companies, they are subject to trade winds. But the market seems to be discounting that risk today in favor of pure growth potential. The sentiment is shifting from cautious optimism to necessity. The data centers being built right now cannot function efficiently without active electrical cables. It's a physics problem. As signal speeds increase, the signal degrades faster over distance. You simply cannot use old passive copper cables for the new AI speeds. The signal dies before it reaches the other end. You have to use AECs. This means Credo's product isn't a nice-to-have, it is a must-have. That distinction is what drives the premium valuation you are seeing on your Schwab Intelligent portfolios. Furthermore, we need to discuss the ecosystem effect. Credo isn't just selling cables, they are selling the CRDAs, the serializer-deserializer IP, the intellectual property that allows chips to communicate. This is a high-margin business. While the hardware sales grab the headlines and drive the revenue spikes, the licensing of their IP creates a sticky relationship with chip makers. Once a chip designer builds Credo's architecture into their silicon, it is very hard to rip it out. This creates a moat. If you are looking for investment ideas that have long-term durability, you look for moats. Tesla stock has a moat in its data and manufacturing. Apple stock has a moat in its user base. Credo has a moat in its physics-defying signal integrity.